Welcome back. In today's video, we're going to slow things down and look calmly at something most people completely miss. By the end of this video, you'll understand why the US Treasury now appears to be steering the system, while the Federal Reserve is still operating, but within tighter and tighter boundaries. This isn't conspiracy language, it's structural. And once you see it, you can't unsee it. Let's zoom out for a moment. This topic sits right where law, finance, emergency authority, and monetary plumbing overlap. For years, people expected a dramatic announcement, some big headline saying the Federal Reserve lost control. But that's not how real system changes happen. They happen quietly, through legal frameworks, balance sheets, and crisis mechanisms. Think about that. March 2020 is where everything changes. All 50 US governors declared emergencies, activating nationwide emergency authority under the Stafford Act. That matters because emergencies don't just unlock funding, they reshape who coordinates power. From that moment, the normal separation between fiscal and monetary authority began to blur, not loudly, procedurally. During that period, something important happened. Emergency facilities were created that required Treasury backing. Federal Reserve programs suddenly depended on Treasury capital injections. Balance sheets exploded under crisis justification. And from that point forward, many monetary actions required Treasury approval, funding, or legal cover. The Fed was still working, but not freely. Let that sink in. At the same time, something else happened that raised eyebrows. In April 2020, the United States imported roughly 4,400 tons of gold. That scale, at that moment in history, is highly unusual. Alongside it appeared papers and proposals discussing weaknesses in fiat systems and the need for new settlement structures. From a systems view, that convergence matters. Physical assets were being consolidated while fiat was expanding. Wow. This shifts how gold and silver should be viewed, not as speculation, not as fear trades, but as anchoring instruments for what comes next. In a world preparing for collateral-based settlement, confidence alone is no longer enough. Assets matter again. Think about what that implies. Today, public policy signals increasingly point to Treasury direction over the dollar's future. The Federal Reserve still manages daily mechanics, rates, facilities, operations, but strategic objectives increasingly originate at Treasury level. Exchange stabilization, debt maturity control, liquidity absorption, even managed dollar weakening. These are fiscal tools shaping monetary outcomes. Here's where it gets interesting. The Federal Reserve still sets policy, but within constraints engineered by Treasury debt structure. Treasury issues debt in volumes that force participation. Rate ceilings limit tightening. Emergency facilities require Treasury equity. Losses ultimately land on Treasury balance sheets. The Fed appears independent, but its room to move is pre-designed. That's the leash. Quick pause. If this explanation is helping you see the bigger picture, thank you for being here. If you think someone else would benefit from this calm, step-by-step view, feel free to like or share it. Now let's continue. One implication of this structure is the quiet retirement of the old system. Inflation, whether obvious or disguised, erodes legacy obligations. Debt becomes lighter in real terms. This allows debts to be extinguished without formal defaults, monetary units to be reset, and labor and savings to be repriced. The system isn't repaired. It's transitioned away from. As fiat value fades, tokenization emerges as the replacement rail. Digital settlement units, asset-linked credits, tokenized gold, different names, same direction. Issuance oversight shifts to Treasury. Valuation ties back to collateral. Rules become programmable. Intermediaries shrink. In such a structure, privately organized central banking becomes less necessary. So why does the Federal Reserve still exist? Because transitions require continuity. The Fed acts as operational cover, a shock absorber, an interface between old markets and new rails, and a buffer against public panic. The institution remains, but its sovereignty doesn't. That distinction matters. Plain language, no jargon. The Treasury doesn't fire the Fed. It surrounds it. Treasury controls the debt the Fed must manage. Treasury funds the programs the Fed operates. Treasury defines the emergencies the Fed responds to. Treasury absorbs the risk the Fed creates. The Fed pushes buttons, but Treasury decides which buttons exist. Wow. This isn't a hostile takeover, it's structural evolution. The Federal Reserve hasn't vanished. It's been absorbed into a broader sovereign framework where fiscal authority ultimately dominates monetary expression. Hyperinflation, asset consolidation, and tokenization aren't accidents. They're transition tools. When the dust settles, the real question won't be who controlled the Fed, but why anyone believed control ever lived in one place at all. Thank you for watching and for your support. We inform, you choose. See you again very soon.